Welcome to the Morning Download Podcast, your go-to resource for personal finance, economics, and market insights. In just 8 minutes a day, we provide valuable information to help you make better money decisions. Don't forget to sign up for our free newsletter at https://www.morningdownload.com/subscribe. Let's dive right in. In today's episode, we'll cover US GDP, Tesla's miss, diversifying portfolios, the importance of stock diversification, and Robert Kiyosaki's advice on managing wealth.
Today, all eyes are on the eagerly awaited fourth quarter gross domestic product, GDP report in the US. This report has the power to impact various sectors of the economy. Economists are predicting a growth rate of around 2%, which is expected to be seasonally adjusted on an annualized basis. Investors will be particularly interested in two key areas: consumer spending and inflation. Consumer spending played a crucial role in the last quarter, so any data related to it will be closely scrutinized. Inflation figures will also be closely watched, as they will influence the possibility of interest rate hikes. Different agencies have varied predictions, with the Bank of America expecting a lower growth rate of 1.5%, while others anticipate it to go above 2%. Overall, there seems to be a general consensus around the 2% mark. Analysts are cautioning that the economy may slow down, but they do not believe we are heading towards a recession. Nonetheless, concerns over the economy are impacting the US dollar, and the stock market appears to be relatively quiet. In global news, China's property stocks are experiencing a boost as Beijing takes steps to improve liquidity in the struggling sector. Additionally, the United Auto Workers Union has endorsed President Joe Biden for re-election over former President Trump. Lastly, a survey indicates that U.S. firms have a preference for doing business with India rather than China. Tesla, the popular electric vehicle company, recently announced its earnings, and the results weren't exactly impressive. They missed the mark on both top and bottom line results. Their adjusted earnings per share came in at $0.71, slightly below the estimated $0.73. In terms of revenue, they reported $25, $17 billion, which fell short of the estimated $25, $87 billion. One of the main factors behind Tesla's underwhelming performance is their slowing revenue growth, which is now at just 3%. This can be attributed to increased competition in the electric vehicle market and a decline in interest among consumers. Although Tesla saw a 13% jump in total production and a 20% increase in deliveries year over year, their average selling prices took a hit. On the positive side, net income for the quarter more than doubled to $9 billion, thanks to a substantial one-time non-cash tax benefit of $9 billion. Looking ahead, Tesla warned investors that vehicle volume growth in 2024 may be significantly lower than last year. They also mentioned being in between two major growth waves. Now let's shift our focus to another company in the news, Boeing. The aerospace giant is still facing troubles, as the FAA has put a halt on the expansion of Boeing 737 MAX production. However, there is some good news, as the Boeing 737 MAX 9 has been cleared to return to service. While this is a step forward, it will take time for Boeing to fully recover. On a more positive note, some companies are thriving amidst this uncertain and volatile economy. IBM shares rose after their earnings beat estimates. Nokia experienced a 7% jump in their stock price as they announced a $653 million share buyback program. Furthermore, Netflix reached a new 52-week high with a 10% jump yesterday. Lastly, Microsoft has become only the second company to cross the $3 trillion market cap milestone. When it comes to investing, one important rule to keep in mind is diversification. This means not putting all your eggs in one basket. Many investors diversify by choosing different asset classes, which is effective but may not be enough. To truly diversify, let's talk about stocks. You can diversify even within the stock market. This is crucial because it ensures that no single company has too much influence over the value of your holdings. The average diversified portfolio holds about 20 to 30 stocks, but the number can vary depending on your investment amount and market awareness. Having a large portfolio offers several benefits. It reduces risks, including company-specific and sector risks. It also provides protection against significant losses and opportunities for tax loss harvesting. However, managing a large portfolio can be tricky and may come with higher costs depending on your broker. On the other hand, there are advantages to having a small portfolio as well. Outliers can have a greater impact on your portfolio, allowing you to potentially make more money. Additionally, it's easier to manage fewer stocks. However, having a small portfolio also comes with disadvantages, such as a higher risk of losses if one stock moves in the opposite direction. If you want an easy solution to stay diversified and avoid the headaches of managing a large or small portfolio, consider investing in an exchange-traded fund, ETF, that you trust. ETFs often provide industry-specific stocks and greater diversification with dozens of stocks in their portfolios. This can be a convenient way to achieve diversification while avoiding the drawbacks of managing a portfolio on your own. Robert Kiyosaki, an American businessman and author, once said, "It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for." Now, this quote really hits home when it comes to understanding the true value of money. It's not just about the amount you earn, but also about what you do with it. Think about it this way. You can make a lot of money, but if you don't manage it wisely and make it work for you, it won't have the impact you desire. So, how can you make your money work for you? Well, one way is by investing wisely. Instead of just saving, consider exploring investment options that have the potential to grow your wealth. This can be through stocks, real estate, or even starting your own business. Additionally, Kiyosaki emphasizes the importance of preserving your wealth for future generations. It's not just about the immediate benefits, but also creating a legacy. This means thinking long-term and making decisions that will positively impact not only your present, but also the future of your loved ones. So, the next time you think about money, remember that it's not just about making it. It's about how you manage it, make it work for you, and ensure its longevity for generations to come.
In today's episode, we covered a range of topics including the uncertain economic data, Netflix's success, Tesla's missed expectations, the importance of diversifying portfolios, and Robert Kiyosaki's insights on managing wealth for long-lasting effects. Thanks for tuning in to the Morning Download, your go-to podcast for personal finance, economics, and market insights in just 8 minutes a day. Don't forget to subscribe for more helpful content and sign up for our free newsletter at morningdownload.com/subscribe.